John, thank you for joining us today. The tariff tantrum has been a challenge to fixed income markets broadly and are credited with the rising of rates. John, do you think this is a good entry point as the bond market seems to be settling down?
I do for several reasons. First of all, we are looking at some of the highest yields when you look at 10-year maturities on out the curve to 30-year maturities. We're looking at around the highest yields in approximately the last 20 years. Also, looking at actual inflation data, it continues to tick lower, closer and closer to that Federal Reserve preferred target of 2%, just about 2.5% right now. So your real after inflation yield is looking very attractive. Then you've seen financial markets broadly recover since the announcement of the Liberation Day tariffs on April 2nd. And in part, that's because many of the worst case scenarios in terms of tariffs actually being implemented have been delayed and are probably going to get renegotiated much lower than was initially announced. So that triggered a rally in many financial assets and markets, but not as much of a rally in the bond market. And the bond market, as you pointed out, it has settled down, but it has settled down at higher rates than where we started in early April. So the good news that has been in part priced in other markets has yet to be priced in longer term bonds, even though we see some improvements on the horizon.
Now let's move on to a macro backdrop, John. How are you feeling about inflation, the Fed anticipated responses, and your thoughts about the federal deficit?
Well, the uncertainty injected by the tariffs has put the Fed on hold. I would argue they were probably already on hold because the economy had started off the first quarter of 2025 on relatively solid footing, and inflation was still looking a little bit sticky above their 2% target. Now, the injection of additional uncertainty regarding both the tariff announcement and then the delay, and now negotiations are ongoing as we speak, that has postponed Fed action potentially even further. Now, futures markets do have the Fed cutting rates before the end of the year, probably either one or two cuts. I think that's a reasonable anticipation, in part because we think probably the worst of the tariff impact on inflation is not going to occur. What has so far been confirmed and implemented is that sort of 10% level, and the Fed itself has calculated that the 10% tariffs that are starting to go into effect now might increase the inflation rate only 0.1% above what it otherwise would have been. And that's before you get into the impacts of could it trigger an economic slowdown? Do consumers substitute away from goods that they think have gotten too expensive? Do companies allow their profit margins to shrink so that they don't pass on the tariff impact in a one-to-one ratio or one-to-one relationship? So I think for those reasons, we're still in a decelerating level or disinflationary trajectory, and the tariffs are likely to be more moderate, and they're likely to be absorbed by some of these other factors like consumer substitution, like economic slowdown, and like squeezing of profit margins. So the Fed postponing its further rate cuts, but still the next move from the Fed, even if it's late in the year this year, is still likely to be lower, not higher, in terms of interest rates.
And your thoughts on the federal deficit?
I think the key with the federal deficit, of course, is the negotiation of the extension of the 2017 Trump Tax Cut and Jobs Act. There is a roadmap that is passed the House of Representatives that is now going into the Senate for discussion. That roadmap would include the increase in the debt ceiling by perhaps as much as 4 trillion. The legislation itself is likely to increase the deficit by in the neighborhood of 2.8 trillion above what it would have been if it had expired. Now, I think these numbers are perhaps a little bit larger than what is going to happen in the final analysis. For one, the federal government is not issuing net new debt right now as we speak. That's because we have hit the debt ceiling and because April personal income and corporate income tax collections, which have been in a strong trajectory, and that has partially refilled the Fed's coffers. But one thing that is getting, I think, a lot less attention in the marketplace is the fact that tariff revenues themselves are now starting to come in and are additive to the personal income tax collections from April 15th. And that is refilling the Treasury's coffers a little bit faster and is estimated to be around $200 billion a year at the current levels of additional revenues coming in via tariffs. So looking at the 10-year horizon, it is likely that these numbers could be reduced by as much as $2 trillion over the next 10 years by the tariff revenues. So therefore, if you include tariff revenues and some federal government expenditure cuts that have not been accounted for just yet, the extension of the legislation, if and when it happens, probably in the month of August or September of this year, that could be a lot closer to deficit neutral. It might not be exactly deficit neutral, but I think it could be very, very close if you add some federal government cutbacks. For example, 10% reduction in the overall federal government workforce has been discussed with over a 10-year horizon, $2 trillion of tariff revenue collections. Add that to the $2.8 trillion projected expansion in the deficit from the extension of the Trump tax cuts, you could get something very close to deficit neutral on balance. Now, of course, the heavy issuance of treasuries longer term is one of the reasons why 10-year and 30-year what we call term premiums, or the additional yield above Fed funds that an investor receives for going on out the curve. Those term premiums are higher, no question about it, but I think that is already incorporating the supply outlook. So if anything, relative to expectations, the supply outlook could improve from here.
Now let's move on to the high yield municipals market. John, how are you feeling about the prices and yields available to the high yield muni investor currently? Are they considered attractive? And perhaps more importantly, are they supported by strong fundamentals?
Yeah, I think they are attractive and they are supported by strong fundamentals. And a couple of interesting points I think to think about in answering that question are as follows. The volatility of the rates market and the U.S. Treasury market, starting really in earnest on April 2nd with these tariff announcements, happened at the weakest technical supply-demand frame of the seasonals of the municipal market this year. April, because of the April 15th tax deadline, April tends to be the weaker technical season of the year for municipals. And this year, not only was this year no exception, but this year was actually exacerbated a bit. And that is because after coming off of a record supply year in 2024 of 516 billion bonds issued, then in 2025, thus far, we've been running at 15% above 2024. Now, that's the municipal market overall, which is dominated by high quality. But within those figures, high yield is very, very well represented. So that high yield has also been on a very robust issuance trajectory. So that creates a heaviness, and that meant that when there was interest rate volatility in April, munis and muni high yield were hit harder in price. That means more of a sell-off, more upward movement in yields. Of course, from an entry perspective, that makes the entry point that much more attractive in terms of both spreads and the all-in absolute yield and relative yield in comparison to, say, taxable bonds. When looking at fundamentals, I would say we've seen continued stability. Now, muni fundamentals do tend to lag. So, for example, tax collections this year are essentially based, a lot of them are based on last year's economy, particularly when you look at things like personal income taxes and property tax collections and assessed valuations are based on 2024 levels, but collected in 2025. So muni credit can lag, but muni credit trends that we see currently in terms of things like default rates, which remain low, and tax collections, which remain high, that appears to be a very, very stable overall backdrop.